Arrowhead and Zurich have teamed up to offer multi-line package coverages at competitive prices. We're bringing new life to ambulance insurance. Learn more at arrowheadgrp.com/ambulance.
What is a reasonable rate of return for a property casualty insurance company given today's market conditions and the current investment environment? Will double-digit returns ever return to the P&C industry? Those are a few questions posed to Vincent J. Dowling, managing partner of Dowling and Partners Securities by Carrier Managements Susanne Sclafane during the 2013 Property Casualty Insurance Joint Industry Forum.
With respect to what is a reasonable return, I would answer the question with respect to the new business that's being written as distinct from the reported results. And I would argue that a reasonable return in today's environment would be something in the range of 9%, which would be 700 basis points over the 10-year Treasury, which is ballpark 2%. The industry probably is not close to earning that on the new business. Now, in the aggregate, the reported result will only be in the mid-single digits, as we heard today, and that's after the benefit of the old higher interest rates that are embedded in the portfolio and some positive loss reserve development. So we've got a long way to go. With respect to a double-digit return, to earn a 12% return in today's environment, the industry would need a combined ratio on the new business it's writing between about 85 and 88. I don't think that will ever happen. So the industry as a whole, it's got way too much capital, whether it's National Indemnity, which has 90 billion plus or whatever. The maybe more interesting question as to whether the good companies can earn a double-digit return, and I'd argue the answer is yes. I mean, if you look over long periods of time, this is an industry where there's huge differentiation between the top quartile and bottom quartile companies, for example, and the spread of returns is far bigger in our industry than in other financial services industries. So if you take the really good companies, they've done well over time.
Participants in the reinsurance and Bermuda market are earning double-digit returns. Here, Dowling talks about whether that will continue given competition from the capital markets.
When we talk about reinsurance, I think we have to differentiate between the casualty market, which is clearly not earning a double-digit return, and the property catastrophe reinsurance market, which is a relatively small segment of the entire reinsurance market, but is disproportionately discussed in the U.S., not only because Bermuda is right there, there's so many public companies, and it produces such a big slug of the earnings at some of the companies. So yes, we do believe in the aggregate there will be pressure on the returns on the property catastrophe side from two main reasons. One, you alluded to the capital markets, where we believe a tipping point occurred mid last year with respect to the pension funds deciding that this was now an asset class that they needed to invest in, with obvious implications on supply and demand. And I think you can show that they impacted the rates in Florida last June. And then additionally, someone like Berkshire Hathaway that now has $95 billion of capital and on the margin is impacting rates relative to where they otherwise would have been. So long-winded, yes, the property casualty rates in the returns are probably likely to have peaked. That does not mean, however, there will not be a small number of companies who take advantage of the capital markets, both in purchasing retrocessional coverage, but also in managing capacity for pension funds and others, such that they will be able, as they work through this, to earn higher returns. But that will be a relatively small number of the current market participants.
Dowling says, as a group, property casualty insurance companies are selling below book value, a signal from investors that they don't believe insurers are earning their cost of capital or that they will in the near future.
Well, investors are looking at an industry where they are providing capital They recognize it's an industry that once you provide that capital, it's very difficult to get the capital back from an insurance or reinsurance company because of regulatory concerns, which I might add are quite different than on the bank side. And in that kind of a market, you're making kind of a long-term bet. And if you look at the recent returns, you look at interest rates, you look at combined ratios, it's an industry where execution is very difficult, but the math is easy. It's easy to figure out what do you need to do to earn a cost of capital, which for most companies is probably between 9 and 12% and possibly higher on some of the cat companies, and they're just not doing it. And if you're not earning that cost of capital, then your capital's not worth $1. And so that's in the aggregate. There are a host of companies selling above book value who are doing quite well.
When asked how savvy investors ferret out the opportunity in the property casualty insurance sector, Dowling replied that the only thing that matters with a property casualty company over time is the ability to compound tangible book value per share.
This is an industry that is a growth industry, but the metric is wrong because people always want to talk about growth in premium, and we haven't had growth in premium. But if you look at growth in tangible book value per share, we've had a host of companies, that top quartile I've talked about, that have actually put in 15% plus over 25 years, which are amazing companies. I should not be talking about individual names, but if you are finding companies where the valuation is still reasonable, that has a unique franchise, distribution, line of business expertise or something that's getting thrown in with everyone else as far as the valuation, there's some opportunities. That said, the market's pretty efficient right now, and given the low interest rate environment, there aren't a lot of companies that are, exceedingly cheap. One place that might be interesting is those companies that are selling at big discounts to book, that have good balance sheets, and the management recognizes that even if they're only earning a single-digit return, if you're buying a company that's earning a 7% return and it's trading at 70% of book value, your earnings yield is 10%. If they're then buying back shares and accreting book value even quicker, and you can get up to a double-digit, compounding book value at a double-digit clip in this environment of 2% interest rates, something tells me will be a good investment if we look back in a couple of years.